Analyzing a stock or a company can seem highly complicated, and it certainly does not help when you get bombarded by different numbers, ratios, and percentages when looking up a stock. In this video, I hope I can make it a little bit clearer by teaching you about some financial ratios that investors like Warren Buffett like to look at and what values they want to seek for those ratios. We will look at three ratios that each give us an idea about a specific aspect about a company's health. The debt to equity ratio tells us a company's capability to pay back debt in the long term. The current ratio does the same for the short term, or 1 year. That is, it tells us if the company is able to cover its current liabilities with its current assets. And lastly, we will look at the return on equity, which tells you how well the company is utilizing its equity, that is your money, the shareholders' money, to generate income. All assets a company owns are either bought with equity or debt. Equity being the shareholders' money and debt being, for example, loans. The debt to equity ratio looks at how the company is financing their assets. If the debt to equity ratio is over 1, then the company has more debt than it has equity. A healthy company does not let debt get out of control, so a high debt to equity ratio is considered risky. High debt to equity may also mean that the company will have issues paying back the debt in the future. Warren Buffett prefers a debt to equity ratio of 0.5 or lower because he believes that debt can disrupt even great businesses. A debt to equity ratio of 0.5 means that for each dollar of equity, the company has 50 cents of debt. After looking at the debt to equity ratio, that includes all durations of liabilities, we will look at the current ratio, which measures a company's ability to pay back short-term obligations, short-term being within 1 year. The current ratio uses all current assets to current liabilities. The current assets are assets that can be used within a year. That can be cash, accounts receivable, or other liquid assets. Current liabilities are financial obligations that are due within a year. These can be bank loans, dividends payable, income taxes, and more. A current ratio over 1 means that the company can pay off its current liabilities with its current assets. Warren Buffett likes a current ratio over 1.5. That means that the current assets need to be at least 50% more than the current liabilities. Lastly, we will look at the return on equity. We invest our money in stocks expecting a positive return. The return on equity can give an idea what return the company is getting with your investment. That is, the return on equity is calculated by taking net income, which is the company's sales, divided by shareholders' equity, which is your money. So basically, the return on equity tells you how well the company's management is at using your money to grow the company. Warren Buffett likes a return on equity above 8% consistently over 10 years. It's really important that these numbers are not being used in a vacuum. They must be taken with a grain of salt and should always just be one aspect of a company analysis, not the sole basis of it. Compare companies that are in direct competition with each other to see how they stack up. That's the best way to get some value out of these metrics. So we have a small example here. We have 3 retail stores that are in direct competition with each other: Costco, Walmart, and Target. And we have the debt to equity, the current ratio, and the return on equity for all those 3 companies. And the numbers that are in green are the numbers that would fulfill Warren Buffett's metrics. And we can see the current ratio for all 3 companies is just hovering around 1. So we can see that maybe 1.5 isn't realistic for a retail store, because these are retail stores that are like the market leaders, and they don't have 1.5. So maybe that's something that we have to compromise on. But the return on equity is way higher than the 8% Warren Buffett suggests. And Costco is the only one that's has a debt to equity ratio below Warren Buffett's threshold of 0.5. So this is just how you need to go about it. You need to compare. You need to see if something jumps out, if something's wrong. And yeah, if you got any value out of this video, please leave a comment, subscribe, let me know what you want to learn next. So thanks for watching, and I'll talk to you guys on the next one.